Okay, let's say that your kid, um, thank you. Let's say that your kid goes to the doctor and he does with a sore throat and he gets a strep test. Now, in that particular instance, you want the test to be extremely sensitive. And when a test or any kind of mathematical model is extremely sensitive, in other words, you don't want to miss any kid who has a positive strep test at the expense of pulling in an occasional kid who comes up with a false positive result. So what you're going to do is you're going to overtreat. And you'd rather overtreat in that particular instance because the real danger is to miss a kid who's got it than to treat a kid who doesn't have it. Now, that's what happens when you have a closed system that's extremely sensitive. Now, if we traded an extremely sensitive system, we would pull in lots of market movement at the expense of pulling in a lot of false market movement, and we would wind up with a lot of losers. So every time a kid who doesn't have strep gets a positive test, no big deal. He gets some antibiotics and he goes home. But every time we pull in a false move on a very sensitive um, on a very sensitive closed system, and all trading is really it's a multivariable equation that we have optimized to come out with a dependent variable that's either incredibly sensitive or very specific. So we have to work with a test or a model that is very, very specific. And when you do that, you can see that we miss a lot of market movement. But what that does is it filters out all of the bad um, trades. And the analogy, say, to medicine again, is now let's say the test that you give to a person is one that's going to make a determination as to whether or not they need to have surgery. Now, a false positive test is going to mean they're going to go to the operating room and they're going to have their belly opened up. In this particular case, you can have a very, very sensitive test, or you're going to wind up operating on a lot of people with no illness. It's the same thing with trading. We can't afford to have false positive results. So we have to trade with incredible specificity. And that's what the platform does. Now, in order to do that, in order to define sensitivity and specificity, you have to develop a multivariable equation. And the multivariable equation has to define every parameter that goes into the risk with which we trade with. So, in other words, what are the components of a trade? What are the components of market movement? What indicator analysis? What are the multivariable equations that go into trading that provide us with a predictive value that ultimately is 90% or greater and allows us to trade with a tremendous amount of specificity? And that's what we've done. And it's really a system that's evolved over the course of the last 10 years. It's been modified multiple times. And I can tell you, if I showed you the wastebasket of indicators that I have, that I've put in and dumped and eliminated from the platform, you would really be amazed. I mean, probably 25 or 30 indicators have come and have gone because they haven't increased the predictive value of our trading. And if they don't, we eliminate them. So getting back to the multivariable equation, I just want to point one book out to you, since we're just talking as the Right Line family, about a book that you might wind up you might find helpful and interesting. And I have a whole library of trading books on Elliott Wave, on Fibonacci, on Gann analysis, on technical indicators. And the book that I found to be the most helpful is the easiest book to read. It's called Trading for a Living by Alexander Elder. And you can get it on Amazon for like $9.95, even cheaper used. And I've talked to Alexander Elder. He's a very, very old guy, but he's a really, really, he's a brilliant, brilliant, brilliant man. And what he did was he wrote a book, and in the book, there's 4 or 5 pages that describe what every indicator does and the formula that it uses to crunch out its line. And it gives you a rational approach and makes you understand what you're looking at. Like when we look at this bottom line and we say it's momentum. Well, what is momentum? Well, trading for a living is going to tell you what it is. It's going to describe what an oscillator is. You know, relative strength, the CCI, our stochastic that we use. It doesn't describe order flow because order flow wasn't around yet, but it tells you about volume. And really, I modeled the platform after Alexander Elder's stuff. You know what, Alan? I don't agree with that because we have an alert on the B to tell us that of an impending C. And if we alerted every time there was a potential momentum trade and every time there was a potential power entry trade, man, we'd have bells and whistles going off to beat the band. And listen, we can put an alert on anything. Oh, he did? Okay, well, you know, I didn't even know about that, Charles. If he did, I'm telling you, I might buy it because this is a brilliant guy. And what he defined was the way that I modeled the system over. And it's called the triple screen method. And what he determined from his analysis, and he didn't use the system that we do. I mean, what we do is we've defined the multivariable equation, and what we do with a year of market data is we permute or change one independent variable at a time and look at the outcome. He didn't have that. So like when we define the distance that the open of the candle has to be from the modified 15. Now we arrived at a maximum of 4, and you can see it here. I know I'm still talking theoretical. Right, you see right here it's 5. In order to arrive at that number between 0 and 4, we had to run a year of market replay data over and over again and see that once we got to 5 ticks, the predictive value of our entries began to fall off. And between 0 and 4, the predictive value of the entries remained stable. So that's how we got that independent variable. Now, the thing is, we have determined mathematically that each of these are independent variables. Now, if the distance of the open of the candle was dependent upon another variable, then you have 2 dependent variables, and then you have to create another equation. And you have to optimize those separately from the multiple independent variables in order to determine ultimately what is the positive predictive value or the validity of a trading entry. So these are all independent variables. So getting down to the specifics and the brass tacks, what have we found? We found this. We only want to trade with the institutional traders. Now, I can tell you, I mean, I can't tell you with any great certainty, but I can tell you with what I believe to be a great degree of certainty that the money that we took out of the hands of the traders today, and I really like it when we take money from other people. I don't know why. I'm not sadistic, but that's why we're in the market, because everyone's out to take our money. So, you know, it's dog eat dog. Either they take our money or we take their money. And we are determined to put the money in the hands of our family here, our right line trading people. And this is where we want the money to reside. And in order to do that, we must trade with the institutional boys because we cannot beat them. So we have to trend trade, and we need a system that clearly defines the trend. And this system, I think, does that really quite well. You got it, HW. It is war. We want the 15, that's simply a simple 50-period moving average, and the modified 15 to be in the direction of our trade. And we want the modified 15 to have crossed to the downside on a short or cross to the upside on a long. And that is almost a component of our trading that we cannot change. Now, for a while, I was taking a riskier trade, and I don't even want to go into it, and where the 15 had not yet crossed the 50, and it started to fail. And it gave me the only 2 drawdown days I had for the entire month of September, so I eliminated the trade. So now basically, essentially, we only have a go to trade on a short when the 15s cross the 50 to the downside, or the 15s cross the 50 to the upside on a long, and the 50 and the 15 are both green or both red. Now, as I mentioned, if the 50 is yellow, we have the okay to take a long or a short. And these are both reflective of momentum. Now, the modified 15 is a really, really unique line. If you put the 15 period exponential over it, and you put the 15 period simple over it, they crisscross each other. Because what I wanted to create with the modified 15 was a line that had incredible stability. Remember, we want to trade with specificity. And if we do, we want a line that's remarkably stable. If the line, like a 50-day, a 15-period exponential, chases price action, it's going to whip you into a ton of trades. And then when a ton of false trades, it's going to give you false breakouts. And instead of giving you retracements, you're going to wind up taking I can't even talk now. It's going to give you movements that are not retracements, but they are changes in direction. So it's going to move. It's going to overrun your trade, and you're going to take a loss. So I created the modified 15. Yeah, you got it, David. And the modified 15 is an amalgam of 3 lines. And then actually, until we got Leo into the company, and Leo's really done an incredible job on revising the code of everything and really kind of rebuilding our system. When the market moved really fast, this line used to fray. And at the tip, you could sometimes see the 3 lines, almost like a splayed piece of rope. And you could see the 3 lines pop out. So the modified 15 has remarkable stability. Now, it's going to let a lot of price action go. I mean, you can see that a lot of successful trades, and by successful, I mean market movement of 10, 15, or 20 ticks, come off of a yellow 15. But I know that if we chase all the trades off a yellow 15, we're going to wind up taking a remarkable number of losers. And as I say, if I have one line, which is mantra, it is day trading is never about the number of winners. It is about the number of losers. And the reason that 95 out of 100 day traders go broke is they take a lot of winners, but they suck in too many losers. And when you start sucking in losers, you cannot make money. We had one day this week where we had one loser, and it dropped our net equity to only $290. And the only way we could make that money back was by taking 3 winners. It's hard to day trade if you pull in a lot of losers. And if you do, you won't make money. So that's why you have to trade with that kind of specificity. So we're going to trade with the 15, and we're going to trade with the 50. And then we have a number of indicators to confirm that the trend is intact. Now, the one that is the most powerful is the C candle. Now, yeah, here's the thing, Carlitos. If you try and anticipate the entries, I think it's a losing proposition. Because here's what we're trying to do. And I've seen this happen many, many times. Let's say on this C candle. Now, when did the C candle happen? Now, see, this was a pre-market move. And I just don't like to take them. But it's a perfect structural setup. Here's the C coming right off the modified 15. What every single one of our trades looks to do, it looks to trap traders in a failed counter trend move. And that is really the power and the beauty of the system. It's also one of the reasons why sometimes we get slippage and sometimes we get skipped past our entry, because when all the people in this B candle get stopped out, it gives the trade an incredible amount of force, because not only do you have new buyers being added to the trade here, but you also have all these failed counter trend traders getting stopped out. So the trade gets shoved up. Irrespective of the entry we take, we are always looking to capitalize on people trying to take a failed counter trend move. And that is one of the reasons why it's such a powerful system. Here's the failed counter trend traders. Now, I don't know why these people do it, but it's going to happen forever. People are going to try to turn the market at an inopportune time. We overrun them, and what pushes this trade down so hard is that all the people in these green candles are going to get stopped out. And what we do is we have different signals to tell us, to confirm that a trend is intact. The C is by far and away the most powerful. And in that 10% discretion, if you get a C candle entry, that's where you might take a little bit of leeway. The strategy entry is really more of it's a triangle, is really more of a strategy. That's why we call it the strategy entry, because it requires the modified 15 to have certain slope. The trade can only be a certain number of ticks away from the modified 15. The 50 now has to be yellow or red in the direction of the trade. So it's doing an analysis for you. And the strategy entries are very powerful, and we don't see them that often. See them here? And that was a loser. It's a rare loser. You just got top ticked out of that trade. There's a big winner. And the third one, the other entry we have is the momentum entry. It's the X. And the momentum entry is an alignment of momentum on 3 different time frames. Now, what you will see is that on a multi-candle retracement, on a single candle retracement like a C, they're the most powerful. And they're going to give you the momentum and strategies. A 2-candle retracement also can give you a momentum or a strategy entry. The multi-candle retracements are going to give you the power entries. Now, let me see if I can find one. Always when you look for something, you can't find it. See, single candle retracement, momentum. Single candle retracement, momentum. Let's find a multi-candle retracement. So we didn't get a power entry here. It's nice that I can't find one. It's unbelievable. I see them all day, and then when I look for one, okay, here's one. That's a power entry. Now this is a multi-candle retracement. Now you can't get a momentum alignment because the candles have come up too far, and you're trading against momentum. You're not going to get a strategy entry because it goes against the logic of the indicator, and it's obviously not a C candle. These are the most dangerous entries, and they're still very valid and they still work extremely well. But the multi-candle retracements back to support or resistance with a power entry signal are the ones that you really have to be most careful with. They are the signals today in which I passed up 2 or 3, and every one of them were losers. Every single one of them. And I know that I think Terry said to me, "Thanks for not taking that trade." That was a multi-candle retracement with a power entry continuation signal without order flows and momentum with us. I let it go, and we got run over on the trade. So those are the most dangerous. And as you trade with the platform, these are the things you get used to. And there's so many guys in the room that see these things that really that are getting, I mean, we had a lot of people in the room out way before me. Now, the other thing that's really important, um, now the other thing that we did is determine um, is that order flow is an exceedingly important component to trade. Now, order flow is simply the number of executed buys and number of executed sells in a given tick compared with the number of executed buys and executed sells compared with those of the previous tick. So if you have more executed buys in the tick that just formed in relation to the previous tick on both the 8 and the 18 range, you're going to have green order flow. If you're going to have more executed sells on the 8 and the 18 on the tick that just formed compared with the previous tick, you're going to have red order flow. Order flow is a very important component to trade. The third line is just a MACD system. We have unique inputs, and it took me a long time to arrive at these. They're not the standard MACD settings. And there's a whole host of MACD settings. There's nothing magic. This is just the MACD speed that I like. And when they align on multiple time frames, and if you get Alexander Elder's book, I don't want to make this any more long-winded or than it is. But it's just basically two moving averages, the signal line and your average. And when the signal line is accelerating away from your longer-term moving average, momentum is to the upside. And when the signal line is decelerating back to then momentum is falling, and you get a red line. Now, the first and third lines are really very critical components to trade, and they really help the predictive value of our entries. But it's very complicated to look at. Now, the other thing that we did looking at the predictive value of trading is we found that the oscillator is useless. Now, I leave it in because it doesn't hurt us, and because all the information is projected right onto the price bars, so it doesn't make any difference. But having the oscillator with us on the trade adds nothing to the predictive value of the entry. And you can see, and Toby took this trade. I was a little chicken to take it, but you can see it had a lot going for it. I thought it was a little bit too far off the 15 and the 50. It was a little bit too far off of resistance to the upside. Listen, there's no right or wrong trade. This is the 10% discretionary component that all of us will develop and give us a risk assessment. But what's powerful about the trade is, one, you have a momentum signal, and two, you're trading with order flow and you're trading with momentum. You see that the candle's outlined, and that will always increase the predictive value of the trade. Now, those multi-candle power entries usually do not give you that signal because momentum is not going to be aligned when you get a multi-candle retracement. That's what makes them a little bit more dangerous. But these single candle retracements usually do give you an alignment of order flow and momentum. Now, if it's outlined in pink, you have order flow and momentum. If it's outlined in yellow, you have order flow, stochastic, and momentum, but we know that stochastic adds nothing to the trade. So it doesn't matter whether it's outlined in pink or it's outlined in yellow. And to the upside, we don't care if it's outlined in dark blue, which includes the stochastic, or just in light blue, which is just order flow and momentum. The predictive value of the trade still remains just as powerful. So and the last component of trading is, if the oscillator does not define overbought and oversold, then what does? And what we did with an enormous amount of analysis was define the MA diff and the safe zone. Now the safe zone is only reflected on the forming candle. It's right here. And the safe zone on an 8 range is 18 ticks. On a 5 range, it is 13 ticks. And on a 3 range, we're right now in the process of determining whether it should be 7 or 8 ticks. This is what defines overbought, oversold. And this was done mathematically. We mathematically quantified it, looking at the multivariable equation and changing the MA diff from all different numbers and looking at the predictive value of the outcome. And if you take a trade above the safe zone to the upside, below to the downside, the predictive value of the trade is going to start to fall off, meaning you're assuming more risk. It doesn't mean you can't do it. It just means if you know if you take it, it's a riskier trade. The MA diff is simply the distance between the 50 and the 15. And here, it's 38, and you can see the MA diff here is 38, and we want the MA diff to be 18 or less. This is what defines our overbought, oversold range. We want to stay within our safe zone. And the one thing I think that the people who've been in the room for months see, and the people who are on trial see, is that there's no reason to ever assume additional risk in a trade, because if you have patience, you're always going to get a really good trade. You just have to wait. And if you're willing to have the patience to do it, the trade will come to you. And I think the key in day trading is never press, never fret over a trade that skips past you. Never get upset like I missed a winner, which it did upset me. But the thing is, it didn't change my strategy. I'm not going to chase a trade. I'm not going to go into a trade on a gut feeling. And I am not going to take an entry because I'm antsy and I'm pissed. I am just going to take a trade based on our analysis, on the understanding of what we're looking for and the predictive value of a trade. And essentially, really all we're looking for in every single trade we take is simply this, is the break and the retracement right back, in this case, to resistance. Now, this was right at 9:33, and this is why we don't trade the Russell Open. It's a very, very choppy time to trade, and you can't look at the trade without looking at the time. It's also why we don't trade into news. But if you waited long enough, you got your perfect trade. You just wait for the Russell to settle down, and at 9:36, you got yourself a great short. Now, this was an oversold move that worked, but we're not going to take it. Then we had a break and a retracement. Whoops. Now let's see. Now here, the opening of the candle from the modified 15 was 5 ticks. We don't trade a 5-tick distance. This is a hanging entry. And what would have happened if we would have traded it? We would have taken a loss. We would have gone 3 ticks and come right back up and give us a hit right upside our head. So by clearly defining that the absolute maximum distance from resistance on a short trade is 4 ticks, it saved us this loser, which was otherwise a good entry. This is obviously also a winner, but you need a 2/3 candle close below the 15 to take this trade, and you just can't take this trade short. And it doesn't matter. We don't care. Here's your great trade. You wait. You can't take it on a red 50. You wait for the 50 to roll. There's the retracement, and there's the move up. Now, I don't know where I was and why we didn't take this trade. What time was this? I think we were done at 10:52, and that's why. And here's why you don't have to press. This is just a perfect trade. I mean, why stress over it? Now, you still had a red 50, but if you looked up at the slope, you would have seen it was negligible, absolutely negligible, and this would have given you a 29-tick trade. Just have to wait, and that's really the day on the Russell. And we can go back day after day after day, and you're going to see the same pattern over and over again recur time after time after time. And let's see about this trade. Now it is a green 50. It's 4 ticks. Listen, this is the kind of trade that basically is, I would skip. Whoops. Here. Excuse me. Because of the green 50, it's not yellow, but it's a winner. And it's only 4 ticks off the modified 15. Here's another trade. Now we have no entry, but based on market structure, this is definitely a trade you can take to the downside. And these keep recurring over and over and over again. I mean, I can do this all day. There's another one. The break, the retracement. This is at 12:50 in the afternoon, so we're long out of the market. And up we go. And these very, very rarely fail. And there's the move down. Now this is a trade that I probably would have taken. There's the short. This is a little bit tighter to the modified 15. Let's see how many ticks it is away. It's a momentum entry with order flow and momentum. Now it's 6. It's a little bit of a risk, but this is a really nice setup. And you can see that the 15s cross the 50 to the downside. And based on risk assessment, I would have taken this trade to the short side. This is a trade we took for 8 ticks. This is an auto trader win. This is a trade that I missed. I remember because this trade occurred when I was taking one of the rare losers we had that went for 18. Coming off the 50, we don't trade off the 50 RW. What we do is we look for the distance between the 15 and the 50. Okay? 18. Remember the MA diff, we want to be 18 or less. That's our critical number. Safe zone is the distance from the candle open from the 50, 18. Okay? Okay, let me just add, Jerry, the difference is I just wanted to define a period where the slope of the 50 was so small. Now, I don't know during this yellow. I'll go back to it. The slope of the 50 is so minor that the thing is we don't want to trade against momentum, and the 50 defines momentum. And during this period, I don't know if it would be red or green. But you know what it is? It's a way of allowing you to not have to look up at the slope of the 50 in the upper left-hand corner. Because it's really just showing you the same thing. I'm just trying to make the platform a little bit easier to read, because so you really can focus on price action. Because that's really where we want we want our eyeballs focused. We want them on the candles. That's why all the indicator analysis is projected onto the candles. That's why almost everything we do is projected right onto the candles. So we can look at price action and not have to have our crosshair on multiple time frames looking at indicator analysis. And remember, this platform does fractal analysis. The 3 line looks at 2 time frames. The momentum entry looks at 3 time frames. And the background bias looks at additional 2 time frames. Now, the background bias isn't critical to take a trade. I left it in, and it, it doesn't have any major significance, but it's an additional 2 time frames for order flow and momentum. I could take it out, but I kind of like it. It's kind of grown on me like a fungus, although it doesn't change or trigger my entries. But I just really like the 15, the 50 when it's pretty much flat. When you see it yellow, you can take a long or a short trade because you don't have momentum against you in either direction. Basically it's flat. And if the modified 15 is just pushing down like a lunatic, and you don't have the 50 against you, you got yourself a nice trade. And again, you can see, although this is pre-market, by defining the distance between the 50 and the 15 to take a trade, 7 ticks, we've really made a major leap forward in increasing the predictive value of our entry. We've defined a hanging entry. And you can see how critical market structure is to taking a trade. Look at this particular trade. It's right off the modified 15. Now it comes back. It's a pre-market trade. We wouldn't have taken it. But comes back a little bit and then gives you a 24-tick trade. We're taking it right off resistance with order flow and momentum. And these trades have enormous predictive value. This is what we're going to look for every single time we trade. It's such a simple pattern. And really, I mean, the guys in the trading room have this pattern down cold. And it rarely fails. Now, the thing about the 13 range that worries me a little bit when I take a 13 range trade is that the average true range of these moves, the average move, and the reason we take 2 off at 5 and 2 off at 10 is that we've looked at the average move of a trade. And on crude and the Russell, it's about 12 to 13 ticks. So a 13 range trade is a little bit like driving a tractor trailer, on a mountain road. It doesn't give you quite the maneuverability of the 8 range. And so I really like trading off the 8 range better. But clearly when we get a perfect 13 range trade, I'm going to take it. And yesterday, the 13 range was a real money maker because the moves were huge. There weren't a lot of small swings in the market of 8, 9, 10, 11 ticks. The market made 25 and 30 tick moves. The 13 range became a big payoff chart. But in general, I like to trade off the 8 range. I'm just trying to think what additional information. You know what I was referring to on a trade was basically looking at risk assessment. There's always trades. Here it is. There's always trades that are going to be a little bit in the gray zone. And that's that 10% discretionary component, and this is one of them. Yep. Well, basically, that's a tough one. And this is one that I think I would extend myself on. You get a nice break. You get the retracement. Now you see the critical components of the trade are in place. The 15 is crossed the 50 to the downside. We didn't violate that rule, and that is key. We have a momentum alignment. We have order flow, stochastic, and momentum. Order flow and momentum with us to the downside. We even have background bias with us. So we have 2 additional time frames. We have order flow and we have momentum. The only component of the trade that makes it a little riskier is that it's 6 ticks off resistance. Actually, it's 5. So you have to take an additional tick of risk here. But you have so much going for you. This is where that 10% discretionary component comes in, and this is a trade that I would take. Now, there's only one additional thing. Come on, Alan, you know that you're going to get your first target before you hit that pivot. Let's take a look at the entry and take a look at the pivot. 7 ticks. Comprendez-vous? We don't hit that pivot until we've already cleared our first target. So that pivot, right, as long as we can get to our first target without hitting support or resistance, we're in the trade. If this pivot were 3 ticks away, no trade. If it was 4 ticks away, no trade. If it was 5 ticks away, you know what? If it's a perfect setup and a nice C candle, you're in the trade. The next candle, no way, Alan. No way. You're going to enter on this candle? Come on. Here? Or here? Uh-uh. Look how far you're trading off resistance to the upside. What's to stop this trade on your entry from going right back to the 15? Display the stochastic as I do, David. Can you be a little more specific? Because this is, I mean, the platform just does this automatically. I'm not really sure what you mean by display it the way we do, David. Can you tell me exactly what you mean by that? They're displayed automatically. They're only just displayed automatically on the candle that's forming. I'll show you. On the forming candle, this number is the distance of the open, here's the 3, from the modified 15. The system does everything for you. It calculates every single parameter. The distance from, well, the MA diff is right up here, 27. Those are all our critical numbers right here. We want to know what's the distance of the open, candle open from the 15. That's displayed in real time right here in this box. Oh, you mean the ruler. Just go up here, go to ruler. And then you're going to get your draw tool. It's a double click. If you want to know the distance between the 15 to the candle open, click on the 15, bring it up to the candle open, click on it, and then drag across. And it'll give you the value. So if you were now analyzing trades in retrospect, you would have to use the draw tool. If you're doing it there, in the rectangular box, you mean here, David? Is this what you mean? Okay, I'm just not really sure, what you mean. I'm gonna do that, Pat. I am. The ruler gives you the Y value is just simply the number of ticks. That's all. I mean that's all that's really all it displays. Well, right now this is all it's reading out for me. It's just giving me. It's not giving me a time. I don't know why. It's not. But it isn't. I think. Let me just do it here. Just do anything here. See, I have no idea what the number of bars means. The only thing that I use it for, I don't know what the time is either. I mean, I could find those variables out. Thank you, Toby. I mean, these numbers for us, David, are irrelevant. The only number that's important for us is the Y value or the number of ticks. That's what we look for when I use the ruler. What I want to know is how many ticks am I off the modified 15 when I do a retrospective analysis. That's the only thing that matters. When I scale a trade, I only want to see the distance. Um, and I think this is what you're talking about. I got it now. Let's say we do this. We look at a move from here to here. So this move went 13 ticks in 3 bars, and the time it took to make the move was 3 minutes and 1 second. That's, I think, what you're talking about. That's it. So you can get an idea of how fast the trade evolved, and obviously the number of bars. All you got to do, David, is go to the draw tool. I click on the entry 1 tick above the close of the candle. Of course, not the platforms. Here, I drag it to where I want to make my assessment and click. And then you can move the box any place you want. So it's a 3-click it's a 3-click maneuver. Click on the entry, click on the exit, and then just move the box. No problem, David. Alan, that trade, you're chasing the trade. I mean, you have to enter on the trigger candle. And I don't know where that trade is, but what you were doing was, listen, Alan, on that trade, you had 7 ticks between the entry. Here it is. You had 7 ticks from the entry to the pivot. The pivot is not relevant here in holding up the trade. You were ready at 5 and out, 6 and out for 100% before you get to the pivot. So there's no reason that you wouldn't take this trade. The only reason I wanted to show this trade was simply that the distance from the 15 to the candle open is 1 additional tick. It's 5. In general, our maximum distance is 4. But when you get such tremendous alignment on this kind of market structure setup, you can assume that additional tick of risk. Remember, as long as the platform defines risk and you understand the risk you're assuming when you enter a trade, every trade you take is valid unless you break one of our rules. It is the setup candle. This is the setup candle right here. But you got to enter 1 tick below the close, like we always do, because the close of a short candle acts as a small area of support. It's got to break support and close 1 tick below. And you still have 7 ticks to get to the pivot. Now, the only other thing I wanted to show is you can read book after book on candlestick analysis, and I have all of Steve Nissen's books. And let me tell you, you can drive yourself to drink reading about Japanese candlestick analysis. And I think it has some validity. Most of the patterns in candlestick analysis are looking for reversal patterns. There's a dark cloud cover, there's a shooting star, but there's only 2 patterns that I look at that I think are important and go into my trading, and that is the size of the candle body. Now, when the candle, in Japanese candlestick dogma, the size of the wick is irrelevant. I mean, the wick does not matter. It's only the candle body that is important. Yeah, HW, right? Size matters, but we've got women in here, so we can't go into that too much. But the size of the candle body is important. This shows that we have a lot of selling conviction here. That's what makes this trade so valid and such a great trade. What happens? I want to show you three patterns. Let me just keep the draw tool on. And I know this is a lot of stuff, but eventually all of this is going to become really easy for you to understand. Now these are the three patterns. Let me just get rid of this thing and get out of draw mode. Now this is your classic doji. Now what is this telling you? And why is it tough to enter a trade on a doji? What it's telling you is that the market is opening here. The market, this candle closes here. And the bulls and bears had equal force here. Exactly, Pat, indecision. In other words, both the bulls and the bears could not force this to have a red candle body or a green candle body. They had absolutely equal power in this trade, and it really demonstrates indecision. Now, in this candle, you can see that there's no indecision. The bears are thoroughly in control here. I mean, they were able to create a huge red candle body. Now, this is called a hanging man, and it's a doji variation. Again, indecision. Now, let's say it opened and closed at the same price, which is what all dojis and doji variations do. And let's say the bears pushed it all the way down, the bulls pushed it all the way back, and it closed and opened at the same price. Right. So what you're thinking here is not continuation, you're thinking reversal. This is a hanging man. I'm sorry, this is a hammer. Same thing. Doji variation. The market opened at the bottom, bulls pushed it all the way to the top, and bears yanked it all the way back down, and it closed and opened at the same price. So all of the candles that close and open at the same price without any candle body, like this candle a little bit, this showed you that there was really not much conviction or not much power by the bulls in this candle. And what did it do? It presaged a reversal candle and a big move to the downside. These are the candle patterns that I do respect and I do look at. And there was one trade actually yesterday that somebody pointed out to me, and I believe that actually, and I'll tell you, Toby sent me an email about it. It was an entry, and it was a perfect setup. But the only reason I laid off the entry, I don't know where it was because the candle had no candle body. It had only one tick of candle body. Now, he assumed the risk, but he understood the risk. And as long as you do, there's no right or wrong to it. My laying off the trade was not right or wrong. His taking the trade wasn't right or wrong. He understood the risk inherent in taking it. I understood the risk inherent in not taking it. The risk is I missed a great trade. And that's all that matters in trading. But at the end of the day, what matters is what you put in your wallet. And if you go by our rules, take our conservative retracements in a confirmed trend, stay within the safe zone, use order flow and momentum to your advantage, then that is going to bank you money. And if you look at our trading performance, it's reflected in that. And actually, the last 2 weeks of trading have been our best 2 weeks because I have adopted the most conservative strategy I ever have. which is we are just taking the most conservative retracements off of confirmed trends. Now, people that trade breakouts and tops and bottoms, those are the people that we beat up. Those are the people that we take advantage of. And that's why we don't want to be part of those people. I agree with you, Toby. And that is what kills a lot of traders is lack of patience. They overtrade. Now, I was really, really, really impressed today when I saw Carlitos post a nice profit. And you know what he said? I'm quitting. Allen posted a nice profit, and he said, I'm quitting. That's the way you trade. When you get a nice amount of profit, you take it off the table and you walk. And that's the way you become a profitable day trader. Because even perfect trades on this system have approximately a 1 in 10 chance of failing. And so don't risk any money on a Friday afternoon, especially, this is a religious holiday coming up, and people are going to be bailing out early from the institutional traders are going to be leaving early. It doesn't matter what religion they are. They're all going to leave early today. So there's no reason to assume that kind of risk. Take your trades and out. Our mantra in the room is if we get 3 winners, we are done. If we get 4 and 1, we're done. And when I look in the afternoon, I always see additional trades and additional winners. But it doesn't make any difference. We want to take our profit and we want to walk. Now, I think that's a lot of material. And we've really gone over a lot of stuff. But that really is the core system. And really, what Toby said, I think, is really key. You simply have to have patience. And being in the room, I think, really teaches you that. Of the one thing that people have complimented me on, and I don't want to give myself a canary by giving myself a pat on the back, because the market is such a dark and angry prowler when you're just at the point where you're commending yourself on being such a great trader, it then decapitates you the next day, is you have to exercise an incredible amount of patience. That's really, really what you have to do. You cannot chase the market, you can't get angry at the market, and you can't get impatient. Because remember, this is your business now. And this is the way you want to butter your bread. This is your bread and butter. This is the way you want to put your peanut butter and jelly on your bread. So you just don't want to do anything that breaks your rules, and you don't want to ever get impatient. And this is really the closing. One of the hardest things to do is to see a really great trade skip past you. You got it, HW, is to see a great trade skip past you and then just not care about it and know that the additional trades will come. And if you can do that, there are a lot of people that teach market psychology, but really what it comes down to is 2 words, patience and discipline. If you can exercise patience and discipline with this system, you will make money. Now, there's no way I could have had 12 winners and 1 loser this week on a system that didn't have this kind of validity. It's not possible. Last week, I think I had 15 winners and 2 losers. You cannot have that kind of winning percentage trading a system that has any kind of leeway or wiggle room in predictive value. And remember, we are trading 2 difficult markets. Most trading rooms are in the ES because it trends. It's not whippy. We're trading 2 brutal markets. And I had to really sidestep a couple of real juicy potential trades, but they just didn't fit exactly with my trading, with what I'm looking for, the most conservative retracement. So my fear of letting the winning trade go, I don't have that fear. If that trade ran 25 ticks, I don't care about it. I know eventually I'm going to get my winners. And when they come, I have such faith in this system. I know that this system is going to get me a winner. It's always nerve-wracking. This is a nerve-wracking business, but that's really not on Monday, Pat. But we're going to have it operational next week. And today we're going to do a lot of work. Sure, Mark, I can show you those. Hold on one second. Let me bring up a dome and I'll show them to you. Hold on one second here. I just want to put it on Sim and I'll show you my Superdome. And here's the strategy. And if you want, Leo can format it for you. It's really easy. I take 2 off at 5. I take 2 off at 10. And if you click on here, I thought that's what come up. Hold on one second. Leo, can you bring this up for me? I want to take this off the ES and move it to CL. How do I open this up so people can see that? And there it is. Profit target's 5. That's all you have to do is put that in. And then here, five, 1, 5. And that's the ATM strategy we have. 2 off at 5, 2 off at 10. When you get to your first target of +5, you move to break even, and then the trade moves on a 5-tick trailer. So if the trade goes 7 ticks and then comes back 5 and stops you out, you have two contracts off at 5 and 2 contracts off at +2. If we're lucky enough to go 10, then we have the trade out at $300. And that's really it's a very conservative ATM strategy, but really it's the one that enhances our equity curve the best, because very rarely do we get these 30 and 40 tick moves on the Russell and on crude. And if we wanted to capture those big moves, we would have to use a very big trailing stop. We would have to take 10 ticks of risk on the entire move. And once we got to our first target, we would have to continue to assume risk on the trade. And I don't want to do that. When we get to our first target, I want that trade to be a winner. At RW, I don't think we should. I mean, I have looked at this till I'm blue in the face. I think that taking the conservative approach is no. I listen. I think that this has served us well, and we have played with it and played with it and played with it to try to maximize our profit when we get a good entry. And I think taking the trade out at 5 and 10, taking the $300 is really the best way to go. We get a lot of 11 and 11, 12, and 13 tick trades. Think what would have happened. Now we're out at $300. If we had a 10 tick trailer on the trade, we would come back on our 3rd and 4th contracts or on a 4th contract and make 10 or 20 bucks. It just doesn't. It does not pay on these markets. So if there's no more question, that's it. I mean, the system is extremely easy. Thank you so much, Toby, and thank you for your help and your input in the room. Everyone have a great weekend. We had a terrific week. If you guys got these trades, or you got 90% of these trades, you made money. Jerry, thank you. RW, thank you. Thank you, all you guys. And you guys, I mean this really, are becoming very good traders. And we are going to go on Monday. I'm going to have a gold 8 range open. And I'm gonna pay close attention to that, especially pre-market when we don't have the Russell. Now this is going to be recorded if anybody wants to listen to it. I know it's long-winded and there's a lot of stuff, but I want people to understand what we do and how we arrived at where we are. We're in the process of building, I just want to close with, we're in the process of building a market profile. It is going to be an unbelievably powerful market profile. It's going to show market profile for the day, the week, and the month. And unlike a lot of the garbage market profiles that are out there, this one's actually going to work. Thank you, Tom. I appreciate that. So we're going to see if market profile enhances our trades. We are doing a lot of analysis with Pat's Fibonacci tool to see if that if that increases the predictive value of our trades on the ES. Now next week we are going to be opening the bonds, notes, and ES room. If you're a member, you get that room gratis. We will not charge you for it. If you're not a member, if you want that room, in addition to the room we're in now, it's an extra charge. And remember, the one thing, it's my philosophy. I want to make you guys profitable. If you're a member of our family, you're never going to pay us another dime for add-ons and modifications. And we've never charged anyone anything. And I'll just tell you something funny that I don't think anyone knows about. And this will be my close. Way back when, I just traded for a living for many years. And then somebody said to me, well, why don't you go commercial with your platform? And I really was very hesitant to do that. So I said, you know what? I'll sell it on eBay. And I sold it on eBay. And I started selling a lot of copies. And that's how I got into this business. Really. I mean, people were like, we're popping it off of eBay right and left. And that's why I opened the company about a year ago. And it really was almost a second thought. And listen, Mike, you can be in two rooms at the same time. And the reason is that you have the direct entry system. And the direct entry system, all you have to do is put up the domes. Now there's going to be somebody else. It's going to be hard to listen to two moderators in two rooms. But if the trades have that kind of validity, and you see one go up on your dome, then you can run over to the room. It's really up to you. The thing is, it's going to be offered to you, and it's going to be your pass or play. All right, listen, everyone, have a great weekend. We can celebrate this weekend. Go out, either buy a champagne or a Diet Pepsi. Take your family out to dinner. Have a great weekend. And my anticipation is next week will be no different than this one. Just like last week, we're going to take our conservative retracements, and this is the way we are going to play this market. And this is where we're going to play it every single week, week in, week out. So listen, everyone, great weekend. And I'll see you. Stay healthy and well. And everyone, to my Jewish friends, have a happy New Year. Have a happy New Year to everyone, even if you're not Jewish. And I will see everybody in the room on Monday morning. Take care. Bye-bye.